Hi, you're watching Ideas for Profit on Moneycontrol. I'm Sakshi Batra. SBI Cards IPO, one of the largest IPOs in recent times, amounting to over 10,000 crores, received an overwhelming response with an oversubscription of around 26 times. However, it made a tepid debut on the stock exchanges with the stock closing at a 10% discount to its issue price. Let's try and understand the broad reasons behind the underperformance and whether investors should look at adding this stock despite the muted day one trade. Well, one of the major reasons for the lukewarm listing was the turmoil in the equity markets following the spread of COVID-19. However, the stock's listing performance need not be taken at face value. Case in point, Page Industries, a consumer company listed back in 2007 at a discount to its issued price, but then went on to deliver compounded annual return of around 30% in the past 12 to 13 years. Now, many investors are also wondering if it is actually better to invest in the parent company, State Bank of India. Well, undoubtedly, State Bank of India offers value at a current price of 223 rupees per share, but the novelty factor, along with SBI Card's strong market position, growth prospects and the superior return ratios make it an equally attractive bet. More importantly, we have seen that the value stocks have been underperforming since the past 2 to 3 years and growth stocks keep getting more expensive, which makes SBI Cards more worthy than SBI at this point in time. Now, there is no doubt that traders looking for listing gains were disappointed, but long-term investors shouldn't despair as SBI Card's business fundamentals continue to be strong. Now, one must remember that the scare of the spreading coronavirus or COVID-19 has actually stalled travel and led to shutdown of malls, which make up for a major chunk of credit card spends. Now, while credit card business may take a hit in the near term, the threat of COVID-19 does not dent SBI Card's business prospects. It will be useful to understand its long-term business drivers, earnings potential and also the valuation front. Now, the credit card business in India is expected to grow at a very healthy pace in the coming years, driven by rising consumption spend along with the under-penetrated retail credit market. Increasing e-commerce and also online transactions, push for digital payments and improving payment infrastructure. Now, SBI Card's market leadership along with the strong parentage will enable it to capture a rising share of the fast-growing industry. The nature of the credit card business is such that it can generate high return ratios for a long period of time. Now, SBI Cards generates best-in-class ROA or return on assets of over 4% as yields are also high. Though the expenses on sales promotion and advertising has gone up due to the increased competition, SBI Card's ROE or return on equity hasn't dipped below 25% in the past 6 to 7 years. That said, any move to cap or reduce the merchant discount rate can significantly reduce SBI Card's fee income and damage the earnings growth. Now, though it is difficult to predict, we do not see this as an imminent risk right now. Now, overall speaking, we do see SBI Cards delivering compounded annual earnings growth of at least over 25% over the next 2 years. But the big question for investors now is, can the valuation sustain in this market mayhem? Well, at the market price of about 683 rupees, SBI Cards is trading at 32 times FY21 estimated earnings. Now, SBI Card's valuation looks lofty, especially since the market has really corrected sharply. However, there is more than one reason which makes us believe that its rich valuations can sustain. Firstly, SBI Cards is likely to deliver earnings growth of over 20% in a market struggling to deliver single-digit earnings growth. Now, given the superior return ratios as well, the ROE of around 30%, it can command higher valuations. Second of all, SBI Cards is the only listed pure cards company. The credit card business of other big players like HDFC Bank, Axis Bank, ICICI Bank is bundled with the banking businesses and they cannot carve out a highly profitable segment separately. Now, we have seen that the consumer stocks may be expensive, but despite that fact, they have fallen much lesser when you compare it with the overall market and financial stocks. SBI Cards too, being a consumption stock, may remain resilient in the current market mayhem and will outperform in the long term.